Hi, welcome back to my lecture series for Principles of Macroeconomics. Today, I'll be introducing the financial system and talking about its role in coordinating savers and borrowers. We'll discuss the two types of financial institutions within this system and define how savers and borrowers are connected to one another. Let's start by considering two individuals, Johnny and Susie. Johnny has $1,000 sitting around that he would like to save for future consumption. Susie, on the other hand, would like to borrow $2,000 to pursue some sort of business activity. Now, if Johnny and Susie meet one another, they could arrange a deal where Johnny lends his money to Susie and charges her an interest rate on the loan. Of course, the negotiated interest rate would depend on two things. First, whether or not Johnny could lend to someone else for a higher rate, or perhaps pursue a business activity for himself that would give a higher rate of return than lending. And second, Susie's willingness to pay the interest rate, which is dependent on her expected rate of return on her business project. In any case, let's say they negotiate an interest rate that is mutually beneficial and move forward with their deal. There are a few problems with this scenario. First, it requires our two individuals to seek out another who is willing to lend or borrow. Second, it requires the negotiation of an interest rate that may not provide an optimal rate of return for each person. Third, it leaves Susie with an outstanding $1,000 that she would like to borrow, meaning she'd have to yet find another person who is willing to lend to her. This scenario should help to motivate the fact that a stable financial system makes trading funds much easier for those wanting to participate and will lead to more efficient outcomes for traders. In our financial system, there are two types of institutions to consider. The first one, which matches savers to borrowers directly and can be defined as a financial market. The most important types of financial markets in our economy are the stock market and the bond market. In each of these markets, savers essentially give their money to firms in exchange for some future return, albeit with some risk involved. The second type of institution is called a financial intermediary, such as a bank or a mutual fund, which matches people indirectly. You can think of these as third parties, which basically collect and pool money from depositors or savers, and then lend it out to borrowers, again in exchange for some future return. Let's talk about the difference between purchasing stocks and bonds. First, it's important in an economics course to define this type of activity as saving rather than investing. This will be important when we get to the modeling part of the chapter later on. When an individual purchases shares of stock in a company, they gain claim to partial ownership of the company's profits. For the firm selling stock, this is called equity financing, since they are giving away equity in the company in exchange for funds to grow their business. When an individual purchases bonds from a company, they are essentially saying, here, take my money to grow your business and then pay me back the principal with an interest rate at a later date. It is essentially an IOU, and the bondholder is a creditor of the company. In terms of risk to the saver, stockholders take on more risk than bondholders do, since if a company fails, it must pay its creditors first and stockholders second. Thus, saving by purchasing stocks typically gets savers a higher return on their money than purchasing bonds does. In the bond market, we say that some bonds yield higher returns depending on their level of risk. In general, higher risk bonds will yield a higher expected return. Now, let's talk briefly about the two types of intermediaries. The first are banks. Go back to the scenario with Johnny and Susie. If a bank exists where Johnny can deposit his money for later use, he no longer needs to seek out someone willing to borrow from him. The bank borrows Johnny's money and lends it to Susie, who also no longer needs to seek individual lenders. Also, since there are many depositors coming to the bank, Susie can likely meet the full needs of her borrowing demand without searching around. This third-party action helps to facilitate the match between saving and borrowing, and the bank makes money by charging interest rates on its loans, which are higher than the interest it pays to its depositors. Lastly, mutual funds are intermediaries which basically bundle together various stocks and bonds into one portfolio of assets, which savers can purchase through brokers. Mutual funds are typically managed by fund managers, which charge a fixed management fee for their services. The benefit of purchasing shares in mutual funds, as opposed to individual stocks, is that savers can diversify their assets with only a small amount of money. So this option is less risky than purchasing individual stocks and more affordable to the common person. So now that we've discussed the various saving mechanisms that are available to individuals and the benefits in terms of efficiency to savers and borrowers, we can start to build a model for what we call the market for loanable funds. This is simply a model which helps us understand who is supplying funds, that is saving, and who is demanding funds, that is borrowing or investing, and at what price this trading of funds is happening at. In my next video, we'll discuss this model in detail and also introduce the role of the government and its impact on economic productivity. Thanks, and I'll see you next time.